Hi, it's Rick here with episode 4 of my series, Structuring Your Investment Portfolio. In this video, I'm going to discuss how you might go about creating your own fund with a basket of stocks and what are the advantages and disadvantages. Quickly, the advantages, I think you can achieve a vast improvement in your returns over and above the previous methods we talked about, either buying exchange traded funds or mutual funds. The disadvantage is that it comes with a bit of work. There is no free lunch. So what I'm going to talk about here is not so much the what to buy and when to buy. That's a topic for another video down the road. But really what is involved in managing a portfolio of your own stocks. So get a glimpse of how much management time is involved. So with that, if we recall, in the last discussion, we were talking about an index fund and comparing its returns. And when you look at the amount of time to manage this kind of portfolio, is really very, very little. It's very simple. If you had only two rules, your buy rule is I will buy pardon me, the index when it goes above the 40-week moving average. And the sell rule is I'll sell if it goes below, closes below the 40-week moving average. Those are the only decisions you really have to make. This chart goes back to 2016, and as you may be able to see from here, we would have been in it back here somewhere. I don't know how much before, would have got out here in April of 2016. You'd been in cash until probably July of 2016, and you would have done nothing at all until this point here in October of 2018. So for over 2 years, there was no decisions that you had to make. Here we sold, and then here we bought it back again in 2019. And again, nothing really to do until the COVID crash of February of 2020. So you can see that the management of this kind of a fund is really simple. The key of this is obviously adhering to your stop rules and selling immediately that it goes below the 40-week moving average. Or in some cases, even lightening up if it goes below the 10-week moving average. But we can get into more nuances of that in a later video. But you can get the picture here that this requires very little work. You're in, you don't do anything for at least a couple of years. Managing a stock portfolio is somewhat different. So, like I say, I'm not going to go into what to buy and when to buy, but I will use a real life example. If you recall, on the Labor Day weekend, pardon me, I put out a video called 10 Stocks to Watch, and I reviewed their chart patterns as well as mostly their fundamentals. And these were 10 stocks to keep an eye on. Now, it was not a buy me now list. It was, basically just keep on your radar that these stocks are likely to outperform over the next few months. So you want to keep an eye on them. But for purpose of this, to see what is involved in managing, I'm going to make the assumption that the Tuesday morning after the long weekend, you rushed out and bought an equal position of all 10 of those stocks. So you had $100,000 to invest. You put in $10,000 in each of these stocks. The number of shares you got is just simply the $10,000 divided by the entry price, and that tells you how many shares you're going to buy. And so that becomes your portfolio. It's equally weighted, it's diversified. Bob's your uncle. So now, though, we've got this portfolio, we have to put in, well, actually before this, but you have to have some rules. So your number one sell rule is establish a stop loss. How much am I willing to lose on this stock before the pain's too much and I have to sell? And I suggest, for purposes, for most of you at least, that 5% is an adequate number, particularly in this kind of a market. So my stop loss would be 95% of this price. So immediately I buy it at 36.45. I instruct the broker to put in a stop loss at 34.63. Now, why 5%? My profit target for any stock I buy is at least 3 to 1. So I have a first profit target of 15% price appreciation. So for my philosophy is, for every dollar I'm willing to risk, I want to get on average 3 times that as far as a reward. So while you could put a 10% stop in, which would be much safer, the odds of it going down 10% in a, with good patterns, good fundamentals, and so on and so forth, is a lot less. In my world, it needs to go up 30% for me to make the math work, to get my 3 to 1. And in this particular environment, it is damned hard to get find stocks that are going to go up by 30%. I mean, there's lots of them out there, but most of them don't meet the kind of parameters that I'm looking for. And you're going to be spending a lot of time looking for those things. So I think 5% is a reasonable number. Also, if I have a $100,000 portfolio and all hell breaks loose and everything stops me out, my total loss is $5,000, which is 5% of the total. That's tolerable. I can get back 5% pretty easily. But losing 20, 30% becomes a hole very, very, very difficult to dig out of. So 5% is a reasonable amount. Now, the other thing to consider is, if this 100,000 that you put in on that Tuesday following Labor Day was only 20% of a $500,000 portfolio, so which would be about right nowadays, to only have 20% of your funds invested in the market and 80% in cash. So again, if everything went to hell in a handbasket and you lost $5,000, over the total portfolio, you only lost 1%. So you easily recover from that. The other one sell rule I would have is this stop price is what I would call a trailing stop. So as my stock price goes up, my stop is going up with it. And you can either do this manually, or most brokerage firms allow you to place a trailing stop with either a dollar amount or percentage amount. So in this case, it would be percentage, with your broker. So, check with your brokers and see if they have that capacity. So that's the premise. The rules are simple: 5% stop. At 15%, I would take off 1/2 of my position. So if I have 274 shares, if the price hits 41.92, I would sell 137 shares and keep the remaining half with my 5% trailing stop. So the things that you'd have to do is, first off, you put your good till canceled orders in for stops. And then I would also put, most brokerage platforms will allow you to set alerts. So you get either an email alert, a text alert, or what have you. So if the price of EVH gets to 41.92, you get an alert on your phone or an email or something. Oh, that's hit my profit target. Now you can go into your brokerage account, put your sell order in, and you're not going to miss it. So establishing alert for your target prices would be very useful to do. So we're going to fast forward a week. Here's the closing prices of those particular stocks on September the 9th, the Friday. Now, what I'm marking in this spreadsheet is what was the highest price during the week. In this particular case, this one hit 39.64. And why this is important is because this would give me my revised stop. So this number is now 5% 5% less than this number, whereas this original stop was 5% less than my entry price. So again, if you put in a trailing stop order with your broker, you don't need to do this. I prefer to put my stops in manually, but you could do this every Saturday or every Sunday. Just look at the chart or look at the price brokerage information, find out what the highest price was, and revise your stop, go in and amend your order. The other thing that is critical for me, I'll spread this whole thing out. See how week one worked. Again, this is not what I did or would do, buy all 10 of these all at once, but nevertheless, this is what would have happened in this hypothetical example. So in the case of EVH, it neither hit the stop nor it hit the target, but you can see that the revised stop is now higher than my original stop. So where I'd planned on losing $500, now my maximum loss is $331. But the second example is 0 because I got stopped out. We suffered the full $500 loss on this one. On this one, we got stopped out on a trailing stop for an $800 profit. So again, we don't have any exposure. I'm not going to go through each individual one. This column for me is critical because I check this daily. And I think when those who used to get my emails, I used to have at the bottom of it, how much I had in cash and how much my portfolio damage would be if everything stopped out. And so that's what this attempts to do. So in this particular hypothetical portfolio, if everything stopped out, I would suffer $778 worth of loss, which is like less than 1% of my total account value. To me, that's important because it measures what my outstanding risk is, and can I increase my exposure now? If my risk on my existing holdings is really tiny, I can comfortably add a couple new positions without the risk of doing too much damage to my whole account. So extending this a little bit further, after 1 week, these positions got closed out. I'm left with these positions. They've gone up in value. This is my cash that I now have. My total portfolio, get this out of the way, has gone up by $4,200 or 4.2%. It's not bad for a week. I wish I'd done this. What did the S&P do over that same week? It went from 395 to 406. So it went up 2.8%. So we're outperforming, which is what you would expect. The next thing I track, which is because I trade a lot, but I would highly recommend this for every one of you as well, is I keep my statistics on how many winning trades I had, how many losers, and what is my batting average. So in this particular week, my batting average was 60%. That's outstanding. My year-to-date batting average is running at 38% and change. A 60% batting average is outstanding. And then another more important stat is what was my average win? So it just takes basically all these green boxes, adds them up and divide by the number of wins. My average win was $781. Average loss is 263. So my win-loss ratio, in other words, 781 divided by 263 is 3.0. Again, that's exactly what I'm targeting. That's where I'd love to be. And I can tell you that if any one of us can achieve a 60% batting average and a 3-to-1 win-loss ratio, that will easily double or triple your account in a year, believe it or not. So that's week one. I extended this out to yesterday. I did the math up to yesterday, which is the 19th. And I'm just going to quickly bring in the chart for the QQQ. Well, let's check. We've been looking at SPY, so let's do that SPY because it'll be exactly the same chart. So here's the past week. This is today. So 1, 2, 3, 4, 5 days from last week. You can see we've had this oh shit stuff going on this week. So it's not been a good week. So as you would expect, all those 5 open positions that we had last week all got stopped out. And so now this week we'd have 0, we'd have nothing. I don't know why that number's on there, but anyway. And our account balance is 103. So we lost a little bit. Our account balance is 103,659. So we're up 3.7% for the 2 weeks. And now we're 100% in cash. And how did the market do as a whole? In that week, we're down 1.7%. So it's vastly outperformed. The number of winners stayed at 60%, which is quite super. And then the average win versus average loss, the win-loss ratio is 2.6, which is still highly acceptable. Anything better than 2 to 1 is quite good. Like I say, I strive for 3 to 1. I haven't historically ever been there. I've been at 2.5 to 1 is sort of my zone. So it may seem a little overwhelming, but really it's not. It's just you build a simple little tracking spreadsheet, something like this, which obviously I can help you with. And as positions get closed out, you have a decision to make. Do I just leave that in cash, or do I find another position and start redeploying? And that will be a function of what the market's doing. And as we all know, right now, you wouldn't be buying a damn thing, not with a chart that looks like this. So I hope that helps. Reach out, have any questions. I know one of the videos I will do sooner rather than later, although we're not ready to buy anything yet, is I will prepare a video on on the what's to buy and then when to buy it. We can, rather than just phone your broker or place an order on a Monday morning at random, we can pick better entry points, which can even improve further on these results. So that's it. Talk to you next time.